Ugly stop theory. Ugly stop theory is any attempt to manipulate the probabilities of your trade. What I mean, if you were to buy right here and you had to stop here, take profit here, so this is a buy, it's a plus. Anything you do to try and reduce the probability of getting your stop loss hit, or increase the probability of your take profit. That is stop theory. So one way to know that you're participating in a mechanism that uses stop theory is it is any time anything with a stop location. That is fundamentally stop theory. So if you use a strategy where that you buy and your strategy recommends a stop down below the low or take profit up at the high or something along those lines, then you're using stop theory. Why is that important to recognize? Because ugly stop theory is not analysis. It is a filter. Filters are not standalone processes for trading. So here's what I mean. Before you can buy into this market, you would need some analysis to tell you that that's a good buy. This is number one. It must happen first. This is sequential. Second, you need some sort of filtration through this area to allow you to know where and when to execute. That's ugly stop theory. That's where this comes in. You start looking for things like a low 2, 1, 2. You look for things maybe like a double bottom. There's a double bottom. You look for things like some sort of break in a trend or something like that. Maybe you have a whole bunch of trend lines break and that tells you something. Anything that reduces the probability of your stop getting hit, that tells you things are at that moment turning. It's not analysis. Then you can look at the execution process. So first you get analysis, then you get filters. There's usually a lot of them. Lots of different ones. Then you get execution, which is where you actually fill the order, and that's usually that's a personal thing. How people like to fill orders is usually just how you like to fill. And that'll be execution. And then after execution, so just to be clear, it's 1, 2, 3. Then everything past that's money management, and we're not focused on that. Okay? So if you're using a mechanism that just tells you where to put your stop loss, and it tells you where your take profit is, and it allows you to feel like your stop is somehow safer. It gives you some sort of comfort because, I don't know, there's some sort of analysis line here that says, you shall not pass. It's never going to get past that. That is stop theory. It is not analysis. It's a filter. Filters tend to have like 10 times the signal rate of analysis. Analysis have like 1 to, so it'd be like 1 to 10. So you get a ton of filter signals. 1, 2, 3, 4, 5, 6, 7, 8. Ton of filter signals and only one analysis signal. And you tend to look for a bunch of different filter things to do some sort of confluence in an attempt to alter that probability. Now, in my experience, there are 2 types of ugly stop theory, whether you're using Bollinger Bands, volume profile, price action patterns, RSI, CCI, trend lines, extensions, channels, overbought, oversold, dark pools, tape reading, any of it. There are essentially 2 types. One type is distribution. Distributions are essentially the fact that markets are inherently range machines. And so when you're tracking something like an oscillator or any of those things, you're essentially trying to say that markets have something called a low and something called a high. And they help you answer this question: what's low and what's high right now? Anytime you have a line that lets you know where low is and a line that lets you know where high is, you're dealing with distributions. The second type is risk tolerances or stop losses. Stop losses are the fact that you know if somebody sold, I don't know, they saw this sort of like wedge thing here and they shorted here. They held on to it. Right now that these guys will have taken their stop, and a lot of people actually just leave it because that's what people do, but a lot of them will have moved it down, what, like here? And there's a really good chance that there's a bunch of stops sitting right there, right? So stop losses, you're looking for where people get stop loss out, but you tend to want to see losses, not break evens. But break evens are okay, but I'd rather, if you're going to use a ugly stop theory, I'd want to see price go up and actually stop them out with negative numbers. So these are the two types that you're going to run into, and you can twist them up however which way you want, but you're always looking at either distributions or stop losses, and that's just how they work. So make sure, if you're using ugly stop theory, that before you look at any of those tools in ugly stop, you already know your analysis. Your analysis has already told you there's a bullish or a bearish bias in the market, or you have some precedent that says there will be institutional buying or selling, or something that gives you direction first. Then look at your filters. Then execute.